Most beginner investors dream of finding the one perfect company, the next big winner, the single investment that quietly changes their life. They put hours into research. They make a bold bet. Sometimes they win. Often they lose. There is a quieter, calmer idea that has guided successful investors for generations. Instead of trying to find one winner, you spread your money carefully. That idea is called diversification. At its core, diversification is the practice of spreading your money across many different investments, so that no single one can ruin your financial picture. Different companies, different industries, different regions, different types of assets. Each piece behaves a little differently. When some are struggling, others are usually doing fine. The overall result tends to be smoother and steadier than betting everything on a single name. This matters because the world is unpredictable. Companies that look strong today can struggle tomorrow. Industries that dominate this decade can fade in the next. Even great businesses can stumble. Diversification is not a guarantee of profit. It is a quiet form of protection. It accepts the truth that no one can perfectly predict winners, and it builds a system that survives surprises without depending on any single piece. To understand how it really works, picture an orchard instead of a single tree. A single tree, no matter how strong, can be lost to disease, weather, or pests. An orchard with many different kinds of trees keeps producing fruit even when one or two have a bad season. Diversification turns your investments from a single fragile tree into a wide, calm orchard quietly producing across many seasons. Let us look at a simple example. Imagine an investor putting all their money into a single popular company. If that company has a great year, the result is wonderful. If it has a terrible year, the loss is severe. Now imagine the same investor spreading the money across dozens of companies in many industries. A single bad performer hurts only a small part of the portfolio. The remaining pieces continue to support the structure. A common mistake is confusing diversification with simply owning many things. If you own 10 companies that all do similar work in the same industry, you may not be as protected as you think. Their fortunes tend to rise and fall together. True diversification requires variety across industries, regions, and asset types. The goal is to own pieces that respond differently to the same world events, not pieces that simply look different. There is also a hidden risk in believing diversification removes all risk. It does not. A diversified portfolio still goes up and down with the broader market. It will still feel uncomfortable during difficult periods. But it usually avoids the catastrophic single-event losses that highly concentrated portfolios face. The goal of diversification is not to eliminate movement. It is to make the journey smoother and the worst outcomes far less severe. A useful way to picture diversification is as the design of a sturdy building. A single thin pillar may hold the roof, but if it cracks, everything falls. Many pillars distribute the load. If one weakens, the others continue to carry the structure. Diversification builds a financial roof supported by many pillars. The roof can withstand small earthquakes that would have brought down a single pillar design. A second key idea is diversification across asset types, not just inside a single asset. Owning many stocks is one form. Owning bonds, real estate funds, international funds, and other asset categories is another. Different asset types respond differently to changes in interest rates, inflation, and economic conditions. A truly diversified plan often combines several types of assets, balanced based on personal goals, age, and comfort with movement. A practical example helps. Imagine someone holding a broad stock fund, a broad bond fund, and a global equity fund. Each one contains many holdings already. Together, the three funds form a strongly diversified base. The investor may add other layers carefully over time. The structure is simple but powerful. A few well-chosen, broad, low-cost funds can deliver more diversification than dozens of individually chosen stocks. Beginners often misunderstand how much diversification is enough. Owning hundreds of different investments is not necessary. A small set of broad, well-chosen funds can cover a large piece of the world. Adding too many overlapping funds creates complexity without much additional protection. The goal is meaningful variety, not endless quantity. Quality of diversification matters more than the raw number of holdings inside your portfolio. There is also a psychology angle. Diversification can sometimes feel disappointing during exciting markets. When one specific stock is rising dramatically, diversified investors often do not feel the full thrill. But during sharp downturns, they also do not feel the full pain. Calm investors learn to value the smoother ride. The wins are slightly less dramatic. The losses are far easier to live with. Long-term steadiness usually beats short-term excitement. A simple practical rule helps you diversify well. Spread your investments across many companies, industries, and regions. Combine different asset types. Use broad, low-cost funds when possible to capture wide groups at once. Adjust the mix gently as your goals and time horizon change. Resist the urge to bet heavily on a single shiny opportunity. A boring diversified plan, repeated consistently, tends to outperform exciting concentrated guesses. There are things to avoid. Do not put a large percentage of your wealth into your own employer's stock. Do not over-concentrate in one country or one sector even if it feels comfortable. Do not assume past winners will keep leading every year. Do not over-diversify into endless overlapping funds. Do not abandon diversification just because one concentrated bet briefly seemed to work for a friend or stranger online. A better habit is to view diversification not as a single decision, but as an ongoing structure. Markets shift. Industries grow and decline. Some holdings rise faster than others. Rebalancing your portfolio occasionally keeps your intended mix intact. You sell a little of what has grown most and buy a little more of what has lagged. This calm rhythm quietly maintains the protection that initial diversification provided in the first place. Over the long term, diversification is one of the quietest but most powerful tools in investing. It does not promise the highest possible return. It promises a smoother ride and a much lower chance of catastrophic loss. Investors who stay diversified, contribute consistently, and remain calm during difficult markets often end up far ahead of those who chase concentrated bets. The orchard outlasts the single tree across many seasons of weather. So here is the short version. Diversification is the practice of spreading your investments across many companies, industries, regions, and asset types. It reduces the impact of any single failure. It does not remove risk entirely. It does not maximize gains in every period. It builds a stable, calm, long-term portfolio. Quality matters more than quantity. Simple broad funds can offer powerful diversification. Steady rebalancing keeps the structure intact over time. If you have not built diversification into your investments yet, start now. Review your current holdings. Notice where you are concentrated. Spread your money across broader, more varied options where possible. Consider simple low-cost funds to make the process easier. Then commit to staying calm through all kinds of weather. Diversification is the quiet structure that lets long-term investing actually work. It is not exciting. It is dependable.